I remember going home to my wife and saying, all year long, I put aside all this money for taxes, and we're not going to need it all.
All my investor friends, I'm calling them all right away, and I'm making sure they're aware of the benefits. And I bet half of them won't even know what I'm talking about.
Something changed in 2017. They changed the tax law, and they allowed for this little funny thing called...
So it'll wipe out their passive income, any other real estate gains they might have.
Unless you're a real estate professional, and then it can wipe out all of your income.
Wow.
Not only does it result in a nice deduction, it is a 100% guarantee they're going to ask for it in an IRS audit.
If somebody's listening to this and they're thinking, man, I've owned this building for 5 years. Have I missed my chance? The answer is no. That's a big strategy where all that capital gains and all that cost recovery vanishes.
Still want to act?
I was just thinking of a good one-liner there. Welcome to Commercially Speaking. I'm Timmy Barron, ADHD. This is the podcast where my much older brother, Bo Barron, CCIM, teaches me everything he knows about commercial real estate. This is the ultimate tax episode, a mashup between two episodes. The first one we shot in February of 2023, where I was quite literally a commercial real estate idiot. And then the second episode recorded a year later, February of 2024, with Kevin Bassett, Bo's CPA. I hope you enjoy it. If you do, let us know in the comments and share this. The information in this is absolutely golden. Without further ado, let's go.
So tax season can often be more complicated and much more rewarding if you own real estate. But there's really 4 reasons why somebody buys commercial real estate in the first place. And there's appreciation, depreciation, cash flow, and equity. All right. Appreciation is the idea that you buy something for X and you sell it for Y later on, and that Y is more. So if you buy something for $1 million, you sell it for $1.5 million. 5-10 years later, it has appreciated in value. It's worth more. Pretty easy. Depreciation is a little bit weird, and it's unique to commercial real estate. Man, if you bought $1 million property, you could depreciate that over 27.5 or 39 years. Now, here's what that means. Okay. If it's multifamily property or residential, you can depreciate it over 27.5 years. So you take what you bought it for minus the land value. You don't depreciate land. And whatever's left, you can depreciate that over 27.5 years. So let's say that comes out to, $10,000 a year of depreciation, and you make $100,000 a year. It would reduce your taxable income from $100,000 to $90,000. So that depreciation is like a phantom expense that you don't have to pay that lowers your taxable income every year. So if you've ever heard somebody talk about commercial real estate as a tax shelter,
Never heard that.
well, that's what they're talking about. It shelters some of your income by creating an expense that's on paper that you didn't actually have to lose dollar bills. We talked about apartments, 27.5 years. Everything else, office building, industrial, retail, that's all 39 years. So $1 million, let's say the land value is $200,000. So you're able to depreciate $800,000 over 27.5 or 39 years. And you just take that number and you divide it by 27.5 or 39, and that's how much you can depreciate every year.
Depreciation, is that the same as a deductor? Like you deduct that?
So it's just like if my business made $100,000 and I spent $20,000 in expenses, my business would only pay tax on $80,000.
Right.
But I actually spent that money. With depreciation, you don't actually spend the money. The government is giving you all that money back over the life of that property. That's appreciation and depreciation. And then there is cash flow, just taking this building that I'm in that we've been talking about. The businesses that are the tenants in this building, they pay me rent, and that creates cash flow. So people invest in commercial real estate because it creates cash flow. You want to kill a business? Deprive it of cash. That's what makes everything work. And then the last thing is equity. I have a loan on this building, so it's worth something, and I owe on it. And so I have a certain amount of equity in this building. But every time these tenants pay me rent, I turn around and pay my monthly mortgage on this building, and my equity increases. So on paper, I'm worth a little bit more every time I pay that mortgage down. Just like somebody who owns a house has a mortgage, every time they make a mortgage payment, their personal wealth and equity increases just a little bit. When you own investment property, your tenants in reality are paying your mortgage for you. Those are essentially the 4 reasons why somebody invests in commercial real estate?
So all those different ways are taxed differently. So one of the first things that's most important is have the right structure, because in the eyes of the IRS, that's either investor income, investment income, or what's called dealer income, which is taxed as ordinary income.
When you say the right structure, like LLC, a corporation, can you give like a specific example?
So if it's a long-term rental property, generally that's going to be in an LLC, taxed as a partnership. The reason being the rules for deducting losses are better. And then if you're a fund manager receiving fees for certain things, those fees should go to the corp, but your interest owned in the building that is the rental part, you hold that in an LLC. So in that case, you need two entities set up. Costs you nothing. They cost about the same to set up and file a tax return. It's just the right structure could save a ton of money.
What if you're a commercial real estate broker?
As long as you're making decent money, most commercial real estate brokers run that through an S corporation, but they'll do all their real estate investments, or most of them, in an LLC.
So when I bought the company from Dad,
Yeah.
I bought a bunch of LLCs. I created an S corp to run the brokerage company out of,
Okay.
like he just suggested. And then one of his companies was a C corp.
Yeah.
And it took me, I don't know, 2-3 years to wrap my brain around this mess of LLCs. But when you hear him explain it, Dad knew pretty much what he was doing. When he
Right.
set all that stuff up.
Right. Right.
And so it's been a big benefit to me, but it took me a minute to understand it all for sure.
Yeah.
Now, when it comes to tax season, here's what people who have commercial real estate, here's what they can do. And in fact, the tax code says they should do this. Think of my parking lot outside.
Okay.
Does that have the same useful life of the building? No. I got to reseal that thing every 5 years or so. The landscaping has a shorter useful life. The carpet inside the building, that has a shorter useful life. There are components of this building that have no business having a useful life of 39 years. So the government allows you to do a cost segregation study. So what you do is you grab an accountant or an engineer who knows how to do this. They come in and they, on paper, deconstruct your building, take all the components of your building, and they put them on different life cycles. I think there's a 5, 10, and a 15-year life cycle, and then there's the 39. This is a retail building, so it's 39 years. So what that means is, right now, if I don't do a cost segregation study, I take the value of the building minus the land, divided by 39, and that's what I get to depreciate every year. If I do the cost segregation study, then some of that value is going to be removed from the 39-year schedule and put on a 5-year schedule. So let's say $100,000 gets moved from 39 years to 5 years. Now all of a sudden, that 100,000 divided by 39 was going to be something small. 100,000 divided by 5. Now I get to depreciate 20,000 a year. So after the cost segregation study, it moves a lot of that value onto these schedules that allow you to depreciate faster than the 39 years. I'm not getting to depreciate more than what I paid for the building, but I get to depreciate more of it up front. So let's say I made $100,000 in a year, and because of my commercial real estate investments and the cost segregation studies, I get to depreciate $95,000 in a year. My taxable income would be $5,000.
Wow.
Would you give us kind of a high-level explanation of how that actually works and why it benefits the investor?
So cost segregation is absolutely one of our favorite strategies for real estate investors. And as you explained in podcast number 2, Bo, I got to give you credit. You got almost everything right. So it's
Almost everything.
So you can break the property into pieces. And for example, I'm in a commercial building that we own, and we're 7 tenants. And if you can tell behind me, but the drywall we picked, you see there's a seam here because it's removable drywall. I picked it specifically so we could cost segregate it as 5-year property or 7-year property, excuse me.
See how smart they are.
Superpower.
Since we bought it and it was an existing building, you're able to take even land. This is one minor tweak from what you said. Land is generally not depreciable. However, if you do a cost segregation of an existing project, some of the land does become depreciable because of land improvements that already exist, which is your sewage that runs underneath the dirt. And then you got sidewalks and parking lots and landscaping. Cost segregation is really powerful because it takes generally 20 to 30% of the cost of the project and breaks it into components that are shorter class lives. Instead of getting written off over 39 years, they can get written off over 5, 7, or 15 years. And with bonus depreciation, all those 5, 7, and 15-year components can actually be bonus depreciated in 1 year.
Now, you're going to pay $7,500 for the study. So a lot of times, if the property's not worth at least $1 million, it doesn't make financial sense to do. But something changed in 2017. They changed the tax law, and they allowed for this little funny thing called bonus depreciation. And here's what bonus depreciation was. Remember how I said in the cost segregation study, it moves value from that 39-year schedule to these 5, 10, and 15-year schedules?
Yes.
Well, the 39-year schedule, or the 27.5 if it's an apartment complex, that's called the real property schedule. The 5, 10, and 15 years are called the personal property schedule. What the law did in 2017, it said, if you do a cost segregation study, and that value is moved from the real property of 39 or 27.5 years to the personal property of 5, 10, and 15, you can bonus depreciate 100% of it in that year.
What does that mean?
It means you can take all that depreciation that moved from 39 years to 5, 10, or 50. You can take it all up front in that year. All of it. All of it.
Where's the limit?
Let's say I made $100,000 in a year, and I bought a piece of property, and we did a cost seg study, and then we bonus depreciated all of it in 1 year. And let's say that created $300,000 of depreciation in that year.
Right.
I can only wipe out $100,000 because that's all I made, but I can carry it forward.
Rollover minutes. There it is.
Rollover minute. That's exactly what it is. It allows me to wipe out my next $200,000 worth of taxable income.
Wow.
And this is something that folks can still do for 2023 if they haven't filed the return yet. So if you are not a real estate professional, which I'll talk about in a second, so a passive investor, bonus depreciation would create a large tax loss, which would wipe out probably all of your passive income. It would also wipe out any real estate capital gains that you had in that tax year, can apply against that. So it can be very powerful if you have sold a property in the same tax year. In fact, the write-off, the deduction might be so large that you won't have to do a 1031 exchange. You can just buy another property and do bonus depreciation, reset your basis, and not go through the time constraints of a 1031 exchange. So we love some cost segregation.
So let me tell you a story that kind of puts all these together.
Yay, story time.
Story time. Buddy of mine sold an apartment complex, walked away with a $1.1 million gain. So he made $1.1 million. So he's going to get taxed on that $1.1 million unless within a period of 6 months and jumping through a couple other hoops,
He buys more property.
he bought more property with it. Okay. So I helped him buy 2 retail centers, one here in Owensboro and one outside of Huntsville, Alabama. He took that $1.1 million, he married it with some debt, and he bought close to $6 million worth of commercial real estate with it in those 2 centers. So he went up, he bought more. So he deferred what he would have owed in taxes into these other properties, doesn't have to pay them until he sells those properties, unless he does it again.
Mm-hmm.
You just keep kicking that can down the road by doing what's called 1031 tax deferred exchanges. But he did a cost segregation study on both of these properties. And then with bonus depreciation, because they both happened in 2022, he was able to bonus depreciate everything that got moved, all the value that got moved from the 39-year schedule to the 5, 10, and 15-year schedule. He made around $700,000 last year, and he wiped out all of it but about $80,000. And he's a guy that grew up poor, and he's now freaking out because he's got real wealth that he's never experienced before, and we just got to show him how to not pay income tax.
Wow.
So he came into 2023 trying to figure out, okay, what are we going to do this year so I can hardly pay income tax again? Now, the only other thing you need to know about bonus depreciation is it sunsets. From 2017 to 2022, you could bonus depreciate 100% of what a cost segregation study moved from real property to personal property schedules.
Mm-hmm.
In 2023, the year we're in now, you can only do 80%. But okay, that's still a great deal. Next year, 60%, 2025, 40%, 2026, 20%, 2027, bonus depreciation goes away, unless they change the law again and extend it or whatever. Who knows?
Of course, we've talked about bonus depreciation before, and you have a pretty good understanding of what that is and how it's kind of phasing out. And there is a bill. Any news about that?
So that bill, it passed the House yesterday and is in the Senate. It's not a sure thing, but it's highly likely that it'll pass. And what it will do is make the 100% bonus depreciation retroactive to 2023. So even though we're here to mostly talk about 2024, that's still something investors could do for 2023. And it would extend it through 2025, which was the phase out period you were talking about.
And then at 2025, would it start to phase out again?
It would end. So bonus depreciation's been around, if you include the current president, 4 presidents in a row. It was Bush, Obama, Trump. And so what happened, it existed and then went away. And the next president came in, it existed again, went away. And then, of course, in 2017, came back at 100%, effective in 2018, and then was scheduled to phase out. So now it may continue at 100% until 2025, and then go away until they bring it back again.
Now, there's one other thing you need to talk about when you talk about bonus depreciation. You can only wipe out passive income, not your active income. So if I'm involved in the day-to-day operation of my company here, that's active income. If you get W-2 income as an employee, that's active income. Like you traded your time and your efforts for that income. If you owned a business but you didn't have anything to do with operating it, that's passive income. Everybody seems to want passive income. Well, depreciation only wipes out passive income unless you're a real estate professional. And then it can wipe out all of your income.
Wow.
To be a real estate professional, you have to spend 50% of your time in real estate. So I'm a real estate broker. Like 100% of my time is spent in that commercial real estate space. There are some rules. You can Google like how to qualify as a real estate professional.
But what's the rules?
So a real estate professional says that you spend at least 750 hours in the real estate trades. So that means you're actively in some sort of a business or profession that you're involved in real estate. So that includes all your real estate agents and brokers and folks that work in the construction trades actually count as this.
Oh, wow.
Now, unfortunately, me as a CPA, even though my clients are real estate and construction, that does not qualify because I'm not actively working with the dirt and bricks and sticks. And so you have to have at least 750 hours in the real estate trades, and the amount of time you spend in real estate is greater than anything else. So if there's a part-time agent that's maybe they did work 750 hours on a side hustle, but they have a full-time job in an unrelated industry that they're working 2,000 hours, they wouldn't qualify. So in a lot of cases, these investors, maybe one spouse is working full-time, but the other one is doing the real estate part-time, and they can get to that 750. We'll make that other spouse the real estate professional. The advantage of being a real estate professional is it allows you to take losses in real estate instead of just going to zero.
Yeah, that is best tax situation I can think of that I've ever heard of. There's a lot of people that own commercial real estate and have never heard of a cost segregation study. You can do it at any time. You don't have to do it in the year that you bought it. So if somebody's listening to this and they're thinking, man, I've owned this building for 5 years. Have I missed my chance? The answer is no.
Wow.
You can do a cost segregation study right now and get the benefits that we've been talking about.
So you really understanding bonus depreciation, what was it, last year or 2022? When did you say?
It was probably the end of 2021. We had bought a strip center in that year. So we put a group of investors together. So when we started preparing for our taxes in the spring of 2022, some of the things I'd been hearing at seminars and conferences and stuff started clicking like, oh, this is what that is. I remember going home to my wife and saying, all year long, I put aside all this money for taxes, and we're not going to need it all.
And the only way to do this is to go into debt.
No. You buy a deal all cash, all of the same stuff applies. If you buy something with all cash, it's probably going to be a smaller property, so there's less to depreciate, right? So debt accelerates everything, but you get to depreciate the bank's dollars just like they were your own.
Go ahead, Kev.
Put some numbers to an example. Let's say you bought a new commercial property for $10 million, just to pick a nice round number. If it's an existing building that fully outfitted, that cost segregation loss could be between $2 and $3 million, 20 to 30% of the purchase price. So now, of course, you financed a percentage of that. So that means you're getting a huge deduction relative to the amount of money you've put in.
Let me unpack that thought real quick. You might have borrowed 60% from the bank and then brought 40% of your own capital to the deal.
Sure.
Right? But you get to depreciate all of it. Like you get the depreciation from the bank's dollars.
This is kind of the end of the story to depreciation, because I've only told you the good parts. When you sell a piece of property, you've heard of capital gains tax. Most people haven't heard of is the cost recovery tax. Here's how it works. You buy a property for $1 million and you sell it 10 years later for $2 million. What's your appreciation there?
$1 million?
You got that right. Now let's say over that time, over those 10 years, you've depreciated $500,000. It'd probably be less than that, but we're going to use round numbers. Your tax basis is $1 million when you buy it, and you depreciate it down to $500,000. When you sell the property, you're taxed 25%. So essentially, the government has allowed you to wipe out all those dollars, but for every dollar they've allowed you to wipe out and not pay tax on, they want a quarter back when you sell it. So when you sell a piece of property for $2 million that you paid $1 million for, it has appreciated $1 million. That's the capital gains portion, and I think you pay 20% on that right now. You pay 25% on what you've depreciated. So there's a big taxable event when you sell a piece of property. You got to pay your uncle. So even though it gives you all these incentives and you can wipe out all kinds of income using depreciation, cost segregation study, bonus depreciation and all that, when you sell, he gets paid. Unless you do a 1031 tax deferred exchange, which means you have 45 days to identify replacement properties, and you have to buy those properties, one or multiple of them, within 6 months of the original sale. And if you do that, you can defer all that tax into the next property or properties, and then you just kick the can down the road.
Essentially, it's keeping you from buying something, making a profit by selling it, and that's it. It keeps you, or it incentivizes you to keep going.
The government wants you to keep going. And then eventually, you're going to have to pay that tax unless you die. And if you die, your heirs get what's called a stepped up basis, and your children can inherit those properties at market value, not at the previous tax basis of their mommy and daddy. And so that's a big strategy that a lot of these commercial real estate investors have, is I'm going to continue to make good deals. I'm going to continue to 1031 into the next deal over and over and over and over again until I pass away. And then my kids will inherit those properties at a stepped up market value where all that capital gains and all that cost recovery vanishes.
1031 exchanges are wonderful. You can defer that gain, kick the can down the road. However, with this cost segregation, it may actually be better to do that strategy instead of the 1031.
Just to unpack this for people who are listening, like we've got some properties that I might want to sell, but the basis on them are basically zero. And so if I do sell, there's a huge taxable event. I got to pay cost recovery on what I've depreciated, which is 25, 30%. Those taxes would become due unless I do a 1031 exchange, which I really don't want to do.
Right.
So the whole purpose of the call was, what other strategies could we look at besides a 1031 that would make it actually make sense for me to exit a property that I think is becoming more and more obsolete and allow me to kind of recast that capital in a tax mitigated way.
Right.
And that's what we talked about was, especially if this bill gets passed and we get back to this point where this year we have 100% bonus depreciation, then, that could be a really good solution.
And then also a real important thing is plan ahead before you unload that thing in a sale. One of your properties, you have a really low basis because you bought it for not a lot, and then you've owned it a long time, so you've taken all that depreciation. So on a sale, you have to pay what's tax on what's called depreciation recapture. So the year before the sale, no later than that, you need to do what we do with our clients is called a recap minimization strategy, where we're going to look at what's on that asset schedule and strip out the stuff that would get taxed at that higher 25% rate. The tax law allows us to get rid of stuff that's no longer in service.
So what I just did last night, I printed off the asset schedule, and everything on these properties that wasn't in service anymore, like the roof that was put on in 1990, that roof's not there anymore. I was able to cross that off. And I spent it took me like 30 minutes.
Oh, wow.
Just going through and thinking, is this still there? Does this exist? Is this in service? And I was just crossing stuff out to take advantage of this. And because I might sell it in 2024, like I have to do this for the 2023 tax return. If I would have had this conversation with him in May after my tax returns were done, like I wouldn't have been able to take advantage of that strategy if I sold the property in 2024.
Okay.
Because I have to do that. I forget what you call it again.
Recap minimization?
Yeah.
Thanks.
He takes good notes.
These are all things that it's just planning, takes a little bit of time. A little bit of planning, that drives down your effective tax rate, and that's the way to do it.
All right. What else?
So main thing, great record keeping, get your structure right, and then cost segregation. Good gracious, if this tax bill goes through and we get 100% for some more years, I would venture to predict that this will help the recovery of commercial real estate, right? Because it really incentivizes plowing capital into these projects.
As a broker, all my investor friends, if this bill passes, I'm calling them all right away, and I'm making sure they're aware of the benefits. And I bet half of them won't even know what I'm talking about.
Right.
Which gives me an opportunity to educate them and hopefully, inspire them to hire me to help them go buy more stuff.
Right.
So that they can, good deal, but then they cost seg it, bonus depreciate it, and wipe out a lot of their, this is something I meant to bring up just to confirm that I understand this right. Let's say my buddies who I'd be calling, they're not real estate professionals, but if they go buy a $7 million investment, they might be able to create $1.5 million of depreciation this year. All right. Well, they don't have that much passive income. So what happens to the rest of it? Let's say they have 200,000 and so all they can wipe out is 200,000 in passive income, but they've got another $1.3 million.
Right.
Is it wasted?
So it'll wipe out their passive income, any other real estate gains they might have.
Sure.
But if they don't use it all, which they probably would not, because they're not a real estate professional, then that amount carries forward against any future rental profits that come through and the eventual gain when that project is sold. So it'll carry forward indefinitely and offset any taxable income from that project or other real estate projects.
Which is why it's so important to do it. Like, especially if this passes, it's so important to do it.
You can bank it for later, essentially, if you can't use it in any particular year.
Yeah.
But if this bill passes and that ends at the end of 2025 and it's not recast or resurrected and it just goes away, you've got a specific amount of time to go buy something, put it in service, cost seg it, bonus depreciate it.
Right.
Bank that depreciation and then use it over time.
Right.
And it could relieve the need to do a 1031 exchange. It could take your passive income down to zero. Or if you're somebody like me, it doesn't matter where the income comes from. Since I'm a real estate professional, I can wipe all that out. So conceivably, I could get to zero taxable income in a year by doing this.
Yeah. And certainly in real estate, there are some years that you may wipe out all of your income, but that's not the name of the game every year. Some years it is. Name of the game is that over time, the life cycle of your business or your investments, that you're paying the lowest tax rate, effective tax rate over the life of the project. But yeah, having negative income all the time generally means you're not making money.
That's true.
One other neat thing about real estate, we're all in agreement, it's our favorite business and asset class, is there's something called Section 199A that exists through 2025. It actually has a decent chance, a bipartisan chance of getting extended in some form beyond that. But what that does is says certain types of income are eligible for a lower tax rate. And in fact, under 199A, it says that certain incomes, which are pass-through business incomes and rental income, 20% of it is tax-free. So for example, if you had income, if you were in the highest tax bracket of 37%, if 20% of it is tax-free, that means the effective rate on that income is 29.6%.
Wow.
So it makes real estate rental income very, very attractive. You make income with other people's dollars, You get to knock it down, the taxability of it, through depreciation. And then whatever's left over on that, it's eligible for 199A, which lops another 20% off.
Wow.
So if you get a great rental income project, whether it's commercial or residential or multifamily, whatever it is, the effective tax rate on that cash flow could be extraordinary.
Wow.
And you generating it, you acquire that asset with other people's money, whether it was 60% or more. So it's a terrific asset class.
Still want to act?
I was just thinking of a good one-liner there about being an actor. I do have a question. What would you say is the threshold for cost seg as far as when someone should pay for it or not?
That's a really good question.
That's a great one. And the cool thing is there's options, which Bo even introduced us to some options. So I love when clients find things. So if it's $2 million or above, that's when I recommend you get an engineering firm, the assets. If it's less than that, there's some do-it-yourself options out there, and you can put it in Google, and there's DIYcostseg.com, or I don't know if I have that exactly right, but there's some good ones that'll pop up, and I've seen the reports, and for assets $2 million or less, they're absolutely good enough. Even on a $2 million asset, if it's generating a $500,000 deduction in year one, that's still pretty worth it to most people.
Yeah, okay.
$2 million and above, though, pay the extra money and get the engineering firm.
Okay.
So you can defend it.
Cool. Yeah, that was a great question.
Insightful.
Yeah.
And one final piece of advice to all business owners and real estate investors: keep a mileage log. It's worth a lot of money to you. And they not only does it result in a nice deduction, it is a 100% guarantee they're going to ask for it in an IRS audit.
What's the easiest way to accomplish that?
Yep, date, where you went, and a mileage amount. I've defended probably over 500 IRS audits at this point in my career. They always ask for it. The good news is they don't spend a lot of time on it. It's like you have it or you don't. And I'm not going to claim that 100% of my clients are great about keeping a log every day, but I will say that 100% of the audits I've defended, we made sure there was a mileage log. So
Yeah.
that would
Great pro tip. That's a great pro tip.
That's really great information.
Awesome.
Kevin, where can people find you?
BassettCPAs.com. Let us know. You can get on our email list. We invite you. We do webinars during the year, and a lot of those, not all of them, but many of them are open to the public if they're on our mailing list. And
Great.
they make sense down the road for us to be your CPAs if you're kind of grown to a certain amount of size where our strategies would be useful for you.
Cool. Putting that in the show notes, y'all.
Kevin, thanks so much for joining us. We really appreciate you having me.
Always a pleasure. Hope you have me back.
Yeah.
Absolutely, we
back.
will. Yeah. Yeah. Thanks, Kevin.
All right, man. I'll see you.
Bye, Alice.
Bye, Alice.
What'd you think of that? Let us know in the comments. If you're on YouTube, please hit subscribe, ding that little bell. Please consider leaving a review on Apple Podcasts. That helps us out a great deal. Every review that we get, we will shout out at the end of future episodes. If you have any comments or topics that you want Bo to teach me in future episodes, leave that in the comments right now. Or you can go over to Spotify and leave us a voice message, and we could play that on the air and shout you out. If you have not subscribed to our weekly free newsletter yet, you can do that at subscribe.wgbarron.com. Every week on Thursdays, you will get several articles about business, productivity, commercial real estate. I subscribe to it because I never want to miss another episode of Commercially Speaking. Thanks for listening. Tune in next Monday for a new episode of Commercially Speaking. Bye, Alice. Oh, we're on social media, Instagram, TikTok. We are going to start uploading all of our episodes and videos to Facebook and X. So you can follow us on all those places at Commercially Speaking. X is a little different. It's at ComSpeakPod. But yeah, we'll see you next Monday. Bye.